Good afternoon and welcome this afternoon to Trading Index Options, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined out there in the chat by my good friend and frequent companion here on Wednesday afternoons, Connie Hill, 20-plus year veteran of the financial markets and a great educator in her own behalf. She's going to be there to help facilitate the conversation for those of you that are here in the live version of the webcast. Chat in your questions, be a part of that conversation. For those of you that are here in the recorded version, leave us a comment in the comment section. We'll get back to that as quickly as we can. Well, it is midweek, as it always is on Wednesdays, usually. We've got Fed minutes that have gone through. We've got NVIDIA and a bunch of other tech earnings still on tap. Some retailers and other things that are driving indexes. But at the same time, we've also got things like changes afoot in the bond market. So we've been seeing yields rising, which is impacting the indexes as well. So we're going to talk a little bit about that. The other thing I want to talk about is the fact that we know that we've got impending changes to pattern day trading rules, PDT rules. Those are coming up. Exact timeline on PDT is TBD. So we're going to talk through, though, some of those factors that as we get closer to expiration into 0 days till expiration options, that traders that are perhaps a bit more short-term oriented might want to be focused on. And we'll talk about some of the resources associated with those. So as we jump into this discussion, a couple of quick housekeeping items. Remember that everything we talk about simply for illustrative and educational purposes only. It is not any kind of a recommendation or advice about a particular security or strategy. Remember that investing involves risk, including the loss of principal. If you're going to trade equity and index options, they carry a high level of risk. They are not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option transaction. Also, remember that the options that we're primarily focusing on this particular webcast are European style, which means that they cannot be exercised until expiration. Other options, especially equity options, are primarily American style, which means that they have that possibility of being exercised prior to expiration, which means that there's early assignment risk if you are short those options. We'll talk about some of those characteristics here, and that will also play into the fact that we're talking about and using the thinkorswim desktop software platform today, specifically the paper money version of which that does not facilitate the early assignment of short options. So if we focus on European style options, we don't have to worry about it anyway. If we are trading equity options that are American style, if you're going to do those in a paper money account, recognize that if you transfer your paper, move your trading to a live account, you may have to deal with early assignment that you won't find on a paper money account. So I want to talk a little bit about this particular disclosure, specifically given the topic today. When trading options at or near expiration, consider the risks specific to the strategy, including lack of liquidity, significant price slippage, meaning wide bid-ask spreads, and volatility. But there's another factor, and that is the change in the value of the option premium very quickly. And I guess that falls under the volatility category as well. So be aware of that. We're going to talk through some of the reasons for that in this discussion as we get into the focus on not only our consistency strategy, but also maybe a little bit more short-term based strategy. So again, a couple of quick disclosures there. Let's jump out there into the platform. And I love the comment that Duke made here, which is, feels like the 24/7 market will be chaotic. And I have a tendency to think that you're probably right. That there's going to be a little bit of chaos. If nothing else, I think it's going to speed things up. However, that being said, giving additional opportunity to trade once liquidity comes in, which it eventually will, may provide a bit more stability, because there tends to be kind of a crush of activity right around market open and market close. So if you extend those hours, maybe it smooths things out a little bit. So this is the name that a lot of traders are perhaps watching today. Big earnings announcement for the technology sector, for the AI build out, those types of things, NVIDIA. And that's driving a little bit of volatility in the broad market indexes today. So as we jump over here to our index grid, let's take a look at what's going on in the indexes. The SP 500 index making a little bit of a move back up above 7,400, currently sitting at about 7,421, so up almost a full percent on the day. But giving a little bit back off of the top of that candle, so kind of pulling back just a little bit after this morning's rally significantly higher. Taking a look at the more directly involved and driven by the movement of NVIDIA NASDAQ index. And you can see kind of that morning star type of candlestick pattern where you get a down candle and then you get a doji star. And then you get an up candle that gaps up above the body of the doji star that we might refer to as a morning star, the dawn potentially of a new trend. So there's a fair amount of bullishness here in the index. Taking a look at the Russell 2000, big bullish day, which is interesting, given the fact that yields, interest rates, have gone significantly higher. If we look at an index, TNX:CGI, which is how we get the quote. This is the 10-year. Now, 10-year rolling back off just a little bit, which is maybe what's driving that move in the Russell 2000. The Russell 2000, because it's primarily small caps, and because it has a focus on regional banks, tends to be fairly interest rate sensitive. So when interest rates have been rising, that's been driving the Russell 2000 down. Interest rates backing off like they're doing today has a tendency to pop that Russell 2000 because those are companies that have to borrow. Now, will it continue to pull back? Good question. If we look at TYX index, CGI, these are both indexes. And unfortunately, these are non-optionable indexes, so we can't trade index options on them. But you can see that the 30-year rolling off a little bit as well. So these are the bond yields and starting to see those moves coming back down a little bit. That maybe on the heels of the Fed minutes and the fact that we've got a new Fed chair being sworn in on Friday has perhaps calmed that bond market somewhat. There was some bond selling, pretty substantial bond selling in the last couple of days, which was driving this yield higher, which also now suggests that if there was a backing off of bond selling, maybe there's some bond buying going on, which is pushing yields down, which is maybe why we're seeing a little bit of a rotation out of, or had been seeing a little bit of a rotation out of some of the broad market indexes. And you see how around and around and around we go with those names. Let's take a look at one other index here. As we kind of view the market posture. And let's take a look at the VIX index. So I'm going to pop back in here. We'll take a look at what's going on with the VIX. The VIX is down a little bit more today than it was earlier. Still sitting just below its average, but not at its lows. So still maybe coming up off of that low a little bit. As we get towards the end of the day, perhaps giving us an indication that there's a little bit more uncertainty. We're in the last hour of the trading day. And so that VIX starting to come up off of those lows just a little bit as we get closer and closer inexorably to the NVIDIA earnings at this point. All right. But VIX overall, from the course of last week, where we were last week to where we are today, a little bit lower. Not hugely lower, but a little bit lower. So that would suggest that maybe that's benefited our 14.7 trade. So let's do this. We're going to come back over here to the monitor tab. Now, for those of you who have been in this webcast before, you are familiar with this particular strategy. For those of you who have not been in this webcast before, welcome to you for sure. But one of the things that we've been doing for almost 2 years now is a consistent strategy of every Wednesday, every time we teach this webcast, selling a vertical spread on the SPX with 14 days remaining till expiration, and then buying it back at 7 days to go until expiration. Well, here it is, 7 days to go until expiration. We sold this vertical spread last week, the 7,271.80 put spread expecting the index to go higher, and expecting the time to pass, and expecting implied volatility to go down. We sold it for $1.90. It's now trading for $1.20. So we're not, if we were to close it out right now, which is our rule, at least as far as this consistency strategy is concerned, buying it back today, come what may. We're buying it back for about $1.20, which means we're keeping about 70 cents of this premium theoretically. Not a huge amount, but a little bit. But we're not taking a big loss. Where yesterday we were taking a big loss, potentially if we had closed it out yesterday, because of that quick downside movement of the S&P 500. So what we're going to do is we're first going to close this down. We're going to right click and we're going to create a closing order, and we're going to buy this one back. We bought it, we sold it for $1.90. We're going to buy it back for, it's probably going to fill pretty close to that midpoint of $1.20 or so. And we're going to go ahead and click on confirm and send. We're going to fire that order off, and we're going to close that down. We'll see what we get it for. We may have to bump that around a little bit. Oh, we sold it for $1.10. Or, I'm sorry, we bought it back for $1.10, which is great because now we kept about 80 cents of that premium instead of about 70 cents, which is great. I mean, it's not huge, but it is not our theoretical maximum gain. It's not even 50% of our theoretical maximum gain. But we're not taking a loss on the trade. Speaking of not taking a loss, I see out there in the chat that there is a feedback survey, and that feedback survey allows us to make these webcasts better for you. So if you wouldn't mind taking that link, clicking that link, opening up that page, setting it aside even, and then you can come back and you can fill out that survey after the webcast, or you can fill it out right now. But either way, gives you the opportunity to kind of get that going beforehand so that you don't forget about it. All right. So Rita asks a question, and this is a common question, and I appreciate the question. What do you think about selling 45 days out and buying back in 2 weeks at 30 days? Wouldn't that give us a bigger time decay value? Not necessarily. Because what tends to happen, it could, but what tends to happen is we get to this point where we don't want to be too far out, because time decay tends to slow down, and because we're selling out of the money, we're selling far out of the money. Let me just kind of close this down, and I'll grab my annotation tool. So for those of you that have been in this webcast before, you know what's coming. For those of you that are brand new, I'm just going to quickly illustrate this. So this is the normal time decay curve that we're used to seeing. I'm just going to reiterate this one more time. This is the normal time decay that we're used to seeing. That's the at the money strike time decay curve. But since we're trading an out of the money option, our time decay curve looks a little bit like this. So we're kind of capitalizing on the fact that overall time decay accelerates as we get closer to expiration. So kind of on aggregate across the strike prices. But as we get down to this 14-day time frame, we're kind of over that edge of the curve where time decay begins to really accelerate overall. However, when we're talking about an OTM option, the majority of that time decay comes because we're far out of the money. The majority of that time decay comes in the first third or so of the lifespan of the option. So from about 14 days to about 7 days, and then this is 0, right? So it's not a linear display. It's not to scale, if you will. But that time frame from 14 to 7 is where we see the majority of that time decay. Now, do we see something similar to this? Yes. However, here's what happens. If you were to think about that red line, okay? Let me just kind of do this real quick. So let's put this on a longer curve, okay? And I'm going to put this on a longer curve, and we're going to make this the out of the money option. We'll keep it in red here. So what tends to happen for an out of the money, for even an out of the money option, which has a small rate of time decay further out from expiration. Let's say we were out here at 45 days to go until expiration. And then here we are at that 14-day time frame, and then at 7, and then at 0. So here's what typically tends, and we can go into the math, and we'll do this one of these days. But what typically tends to happen to that out of the money option, so just label this again, OTM, so that we can remember that this is the out of the money option. That rate of time decay tends to be fairly static along with the in the money options, right? So this is kind of that parabolic, because we think about this as kind of half of that parabolic curve. So tends to be fairly static. We don't get a lot of time decay. And then what starts to happen is we get down to this time frame close to that 2 to 3 week time frame prior to expiration. This rate of time decay starts to do this, meaning it starts to accelerate, and then it flattens out. Okay? Then it flattens out. So what I want to draw is what these curves look like. This is the out of the money option curve. We know what the at the money option curve looks like. If we were to take this curve and kind of look at it in the whole, right? If we were to look at it as a parabola, then what this out of the money curve looks like is essentially this, right? What the at the money curve looks like is a curve that is flat and linear to expiration. You don't get this kind of convexity of time decay here. So we're capturing that convexity of time decay in that front month. That's one of the reasons why we look at this as being a little bit more short term. But give it a try, Rita, at 45 days out, buying back in 2 weeks at 30 days. But my guess is, mathematically, without doing it mathematically, that if we were looking at 45 days and you were buying it back at 30 days, that's going to put you in kind of this very slow rate of time decay, and it's not going to be as time decay or theta driven in that portion of that time decay curve, as opposed to when we get closer to expiration. Now, the trade-off to this, and there's always a trade-off, right? The trade-off is that the more time we buy, or the more time that we sell, the more premium there is to be had. So we might be objectively selling more premium. It's just not going to decay away as fast, and it's not going to behave the same way. So I hope that helps in terms of that understanding of, kind of why we're looking at this range. Now, look, here's what I get. I get the trepidation about selling short-term premium, selling short times to go until expiration. Is, oh, well, wait, what if the stock moves? And what if we get assigned? But wait a second. These are index options that are European style. So we don't have early assignment. We can't be assigned early on these options. So we take that trepidation portion out of the trade. So that gives us perhaps some license, if you will, to trade a little bit closer to expiration and benefit from what we know about the rate of time decay. Okay. So what we're going to do now is we're going to go back to our grid here, and we're going to change this to our index options grid. Right there, index options grid. By the way, the link to this grid is in the webcast description page. What we're going to do is we're going to say, all right, how far out is our 14-day? That's the 3rd of June. Whoops, 3rd of June. So we're going to go to our chart. We're going to take our time hack here, and we're going to say, all right, we're going to move that out to the 3rd of June. But first thing we're going to do is determine what direction we're going to sell. The S&P 500 is still above the 200 period moving average. That means we're still selling put spreads. We're still bullishly directional. So we're going to take this time hack and we're going to move it out to the 3rd of June. So 1, 2, 3, there's the 3rd of June. And now I'm just going to look for the crossover. And I'm going to say 7180 is my crossover of that time. 7180 crossover of that time and my probability of expiring cone. This is one standard deviation up or down from where the price of the stock is currently, or the price of the index is currently. So we're at 7180. So I'm going to come back to my trade tab, and I'm going to go to the 3rd June expirations. And it was, I think, a 50-day. It might be a 30-day, Jerry. Let me go back to the chart here and take a look. But what I'm going to do is I'm going to go to the 7180. 7180 is about the 15-cent delta, no gamma, and really about $1.95 of theta. So fairly quick. Remember, we're 14 days to go until expiration. Fairly quick amount of theta. What I want you to see, though, really quickly as we do this, let's go to the 7180 here. Whoops. Let's just mark that 7180 strike. If we were to go out to the 45, just to confirm this, if we were to go out to, say, for instance, the 43 days to go until expiration, and we go to the 7180, we don't have a 7180, we have a 7175, which is pretty close. See, notice that we've got just about the same amount of time decay, about that same rate of time decay, $1.30 at the 14 days and $1.51 here at the 43 days. So time decay is not going to change all that much. It's not going to impact our trade all that much between 45 days and out to 14 days. But watch what happens when we get down here. So 14 days, it's $1.94. It's gone up a little bit. It started to accelerate. We get down here to 12 days to go until expiration at the 7180. That's getting to about $1.84. And then we get down here to 7 days to go until expiration. 7180, it's gone down to $1.69. But then we go down here to 1 day to go until expiration. At the 7180 strike, there's very, very little. There's less than half the rate of time decay. Whereas at the at-the-money strike, that rate of time decay has accelerated significantly. Yeah, and Jumpin' Joe, you're right, absolutely. More often than not, that delta that we're going to end up with is going to be right around the 15 to 17 cent delta, given where current levels of implied volatility are. So we're going to look at selling the 7180, and we're going to buy the 7160. We're going to make this 20 wide. Lots of reasons why this is 20 wide. That's just giving us kind of that balance between theoretical loss and theoretical gain, and still giving us some juice for the squeeze. So bringing in about $2 of premium here on a 20 wide vertical spread. So that means that we're losing potentially about $1,800 if we go to max loss. But this is a highly probable trade, number one. And number two, we're not taking it all the way till expiration. So we're at the 15-cent delta. Delta is not only a directional sensitivity indicator, but remember, it's also an approximation of likelihood of being in the money at expiration, which means that we've got about a 15% likelihood of being in the money at expiration and about an 85% probability of being out of the money at expiration, is the other side of that coin. So, highly probable trade. Theoretically, bringing in about $1.95, $200 against the theoretical maximum loss if we were to let it go to maximum loss of $1,800. So risk to reward standpoint doesn't maybe sound great until you consider the probability of the trade. So we're going to go ahead, we're going to click on send, and we're going to fire that order off. And we got it for about $2. We sold it for about $2. Now, actually, I think $1.95. But what that means is we want to be watching that 7180 strike. If the index continues to move to the downside, or it moves below that level, moves below 7,400, moves below 7,200, starts to move down towards 7180, the premium for these puts is going to get pretty big pretty quickly. So we've got to be willing to kind of sit on our hands, I think, a little bit, because the other thing to think about is as this moves, if the index were to move this closer to the at-the-money position, that rate of time decay actually accelerates, and time decay is going to work for us in this particular case. So, I mean, it's going to work significantly for us. So this is primarily a time decay trade, a little bit of a volatility trade, because if implied volatility drops, if the VIX continues to go down, that's going to work in our favor here as well. And that's going to eat away at the premium of this trade. So that's how we kind of continue to do this 14-7 trade and make sure that that's what we, oh, did I put it someplace else? I did. I just sent it down here to my unallocated group. There it is right there. We're going to have to just move this, right click, move it up to our index options weekly group. I forgot to change it. Now there's our vertical spread. We closed this one. We moved it out a little bit and moved it out to 14 days to go until expiration, sold it for $2. And our expectations, we're going to be able to buy it back theoretically next Wednesday for less than we were paid for it to begin with. Now, I want to talk about, because of those impending potential changes to pattern day trading rules, which would eliminate theoretically the PDT trade counter, which is one of the reasons why traders may be disincentivized, if you will, from closing trades down prior to expiration, and thus leaving especially zero DTE options to just simply either expire worthless or go to max loss, is one of those circumstances that maybe this rule change will benefit. Because if you don't have to worry about the trade counter, you don't have to worry about closing a trade down, incrementing that trade counter, then a trader might be more willing to take a trade off when it makes sense. Here are some of the challenges to zero DTE or 0 days till expiration trades. And I want to kind of go back to school here for a little bit on this. I'm going to go to the trade tab though for our SPX. Now look, we've got, at the moment, we've got an expiration. Now we're almost within 30 minutes to go until expiration, which is the point at which many traders would be closing down 0 DTE options. So we're kind of inside that range. So I want to show you what these forces are that are at work on 0 DTE trades. So I'm going to go to the 20 May expiration. This is the 0 days till expiration expiration on the SPX. These are the options that expire this afternoon. And I'm going to take this back. I don't need necessarily 110 of them. I'm going to just put on here, say 50 of them. And I'm going to put on here delta, gamma, theta, and vega. I'm going to put all 4 Greeks on here, delta, gamma, theta, and vega, so that we can see this. Because I want to compare in the money and out of the money options. So in the monies are shaded, out of the monies are not. In the money options have extrinsic value, or excuse me, have intrinsic value. Out of the money options do not have intrinsic value. And the further in the money, if I were to put, let's just do intrinsic and extrinsic really quickly, just so that we can see it. Intrinsic and extrinsic. The further in the money we go, the less intrinsic value or extrinsic value we have. The further out of the money we go, the less extrinsic value there is. So look, if we were going to buy an option at this particular point, if we were going to buy a long, say for instance, a long put option, cheap long put option, 74.35, right? Or maybe the 74.30. Let's look at the 74.35. If we were to buy that option with an hour to go until expiration here, thinking, wow, the index might go up. And that we might see big bang for our buck here. Even if it goes up a little bit, that's going to maybe increase the value of this option. We can take that trade off or let it go to expiration and we collect that value. As long as it goes to the in the money position. The problem is though, if we go back to our display of information here, we go to delta, gamma, theta, and vega. We still have a fair amount of vega sensitivity, especially clustered right around the at the money option. So even though by and large, the closer we are to expiration, the less significant vega becomes, it's still a significant component here. But notice what's happening to our theta. Theta is the biggest driver, but theta is binary at this point. Theta is absolutely binary because we know that at the end of the day, all of that extrinsic value is gonna be gone. So theta becomes an absolute. But and that's talking about whether we're in the money or whether we're out of the money. That theta component becomes an absolute. But what changes and what's going to really start to accelerate, and what really is the driver of a trade as we get to expiration, is gamma. So as we get into the last little bit, this gamma is going to start to accelerate. And the rate at which gamma accelerates um, prior to expiration and as a function of time is a third order option derivative or option Greek called color. Color is the rate at which gamma changes the closer we get to expiration. So an at the money option and an at the money option has what's called negative color, meaning the closer we are to expiration, the higher that gamma gets. An out of the money option or an in the money option, because they have less extrinsic value, has what we call positive color, meaning the closer we get to expiration, the smaller that gamma number becomes. So what that means is, let me just show you what that means. Let me draw this out for you. The closer we get to expiration, the more peaked that gamma curve becomes. Sorry, that's a bad drawing. But if we're at the money strike, the gamma is going to be the greatest at the money strike, and then it's very quickly going to fall off one way or the other. Which means if we're sitting right close to the at the money strike and the price of the index moves just a little bit, that's either going to add deltas, i.e. add premium, or it's going to subtract premium and destroy deltas really, really fast. So the impact to gamma gets much more significant on that last day to go until expiration, and it gets much more significant in the last few hours and or minutes to go until expiration. Let me show you a visual representation of this. And you can do this too right here on your platform. So I'm going to come down here to the bottom of the option chain. I'm going to scroll all the way down here to the bottom of the option chain to a tool called product depth. And I'll show you how we set this up so that you can see this impact of gamma. So I'm going to scroll down a little bit, and what I'm going to show is options. And I'm not going to show all 60 expiration series. I'm just going to show the today's expiration series and tomorrow's expiration series. Actually, you know what? I'll even go out a little bit further. I'm going to go tomorrow's expiration series and one that's about a week away. So we'll go to one that's about a week away, and I'll show 3 series of expirations. So now what I'm going to show is not implied volatility, not delta, not theta, not rho, not vega. I'm going to show gamma. So this is showing me the impact of my gamma, and this is calls and puts on, calls on the left-hand side, puts on the right-hand side. I can show both. We can show all of those, okay, or show the average of those. So this is the average of calls and puts. So this is kind of the relationship. So notice this. Here's the gamma significance for tomorrow's expiration. Here's the gamma significance for next week's expiration. It's almost non-existent. Gamma is almost non-existent and as we get even into the last day to go until expiration. But notice what's going on. Here we are, 30 minutes to go until expiration. The at the money strike price, the index is currently trading at 74.28, right? 74.28. So let's put our cursor right on 74.28. There's the at the money strike right there, is that where that vertical line is. You can see how steeply gamma falls off to either side and how much that can destroy option premium. Because that delta can change, because remember, that's going to take delta down, which is going to draw down the option premium. Wow, that's why gamma can get you as you get close to expiration. So if you think about it, if you're going to trade short-term option trades and you want to avoid that gamma squeeze or that gamma destruction of delta as you get close to expiration, don't get yourself caught up here in this peaked area of that curve. Look at creating a trade maybe that sells premium and stays outside of this range. So if you're a short-term option trader, zero DTE option trader, it may be beneficial given this relationship of gamma to think about selling out of the money spreads on that zero DTE time frame and collect a little bit of premium with that high probability expectation that gamma is not really going to reach you, especially the closer you get to expiration. But the problem is you're dealing with two legs there, and the price of the index could move. So if you're a zero DTE trader and you're selling vertical spreads and you're worried about the pattern day trading count, the count ticker, the trade ticker to keep incrementing, that's two trades that you've got to take off. So if that trade ticker, that trade counter, that PDT counter is taken away and you don't have to worry about that, that maybe takes away some of that concern about exiting positions positively prior to expiration, as opposed to the tendency to leave those trades through expiration, even if it's a zero DTE trade, to just let them roll off so they don't increment the PDT ticker. So from that standpoint, I think there is a benefit to the idea of that PDT rule changing and taking away that trade counter, because it maybe frees up that opportunity to close these trades down positively prior to this time frame where this gamma really, because just as we've been talking here, as we're getting now down to what, 20 minutes to go until expiration, we've gone from a peak gamma of about 4 cents. It's now peaking out about 4.5, almost 5 cents, and it's going to continue to increase in that peak. That gamma curve that we're seeing in the at the money strike is going to continue to get steeper and steeper, and you can start to see it. It's already starting to do that as we get closer to expiration. And that can destroy deltas very quickly. So that's why many zero DTE options traders either go so far out on the wings that they're not collecting a lot of premium and they ultimately become not successful because they maybe take a couple of big losses that wipe out all of those small gains, or they simply leave the trade on and then they get killed with the index moves a little bit, because remember, that's going to be the at the money strike. And so if you've got an option that has 4 cents remaining and now the index moves and gamma wipes out all of those deltas and wipes out that premium, wow, that could really take what was a winning trade down to a potential max loss very, very quickly. So when we talk about that there are some specific and unique risks associated with trading very close to expiration, this is one of the things that we're talking about, right? Now, there's another third order derivative or another third order Greek that we don't really show. We don't show color for that matter either. But the other third order derivative or Greek that we look at here is speed. And speed is the rate of change of gamma as we get to the at the money strike. So speed is highest at the at the money strike. Speed slows down as we get further out of the money or deeper in the money, where there's no more extrinsic value. Because remember, all of these option Greeks, theta, vega, gamma, charm, voma, speed, color, all of these are all impacts that occur to extrinsic value, not intrinsic value. So something to pay attention to. Wow, we went deep dive on that. But hopefully, all right, at the end of the day, what that means is if you're going to trade short-term options, if you're going to trade zero DTE or one DTE options, think about managing that trade outside of these gamma risk areas, because gamma is going to be the biggest influence that you're going to have to deal with. Let me show you those curves real quick before we go. I'm going to show you what the delta curve looks like on an in the money, or excuse me, on an index option as we get close to expiration. Same thing. it steepens, that delta curve steepens. If we take a look at the theta curve, it starts to go inverse. Remember, this is the function of that out of the money. Remember those out of the money options or deep in the money options? The greatest rate or the greatest impact to time decay is going to be at the money strike. And we can also take a look at something like Vega. Remember that Vega really pretty much just, so here's the one that's 2 weeks out. Here's the one that's trading tomorrow. Here's the one that's expiring today. And so we don't have a lot of Vega sensitivity to this. So this is a great tool. If I can do a couple of short videos on this in the next couple of weeks and try to reinforce understanding of this, but this is a great tool to get used to using and get to know how to use especially if you're a short-term options trader. All right, guys, great stuff. Let's pop back over here to the webcast information page. Let me pop over to, where are we? There it is right there. Let me pop right over here to the Trader Talks webcast page. So if you've not done so already, please click on that subscribe button. And what I'm going to type in here right now is gamma. And here's me talking about zero DTE short vertical gamma grab. In this particular webcast, that was a little over, well, not quite a year ago. Here's Connie talking about gamma. Here's me talking about gamma. Barb Armstrong talking about gamma. So lots of great stuff there. Yeah, my gamma used to bake cookies for me. I like that, Eric. Thanks, man. That's good stuff. But click on subscribe if you haven't done so already. You can find out where we're going to be by going to the in-person events link here on schwab.com/coaching. You can also find our forward schedule of our upcoming webcasts here as well. My thanks to Connie Hill for helping out. Remember, we've got a feedback survey in there, so if you haven't done so already, click on that link, open that up so that you can fill that out. PDT change is coming, Jay Richardson. June 1st, I think, is when the change happens, and then institutions have up to 45 days after that, I believe, to institute the change. So sometime within that time frame is when that's going to happen, when that counter is going to be decremented. Guys, thanks very much. I appreciate you being here. And thanks, Connie, and our great production staff and our great reviewers. We'll see you again very soon. Take care, everybody. Bye-bye.